Hey fam, good morning. Happy Taco Tuesday. Bo Bigley here, mortgage loan officer with Arbor Bank. Hashtag Bo knows home loans, Bo knows mortgages. Wanted to share little tidbits from the old noggin here that a lot of times, first time buyers especially, but any buyers will misunderstand that all that we're looking at from a lender standpoint is your balances. Balances do factor in to your credit score because the percentage on a credit card or revolving account that you use, the more you use, the lower your credit scores. And the longer that balance stays, the lower those scores. So something just to keep in mind, whether you're buying in Omaha, Dallas, or wherever you live, is that a lender such as myself is going to look deeper than just your balances. They're going to be looking at your monthly payments, and they're going to be looking typically at anything that's 10 months or longer, because if it's less than 10 months and it's an installment, not a lease, we can sometimes omit those payments. So one thing to keep in mind is your debt to income ratio, or DTI, is going to be the biggest factor in terms of what you're bringing in per month. You don't typically want to have more than 50% of debt between your housing expense and what you're already paying. And I know that this is probably backwards because I flipped my screen around, but let's say a household is making $6,000 a month, right? They're doing well. They've got $1,200 in monthly payments, and they're going to try to take on a $1,600 a month house payment. That's backwards. It says 47%. You typically want to be between the 45 to 50% range at the ceiling, and that way you should be able to qualify with a credit score of, let's say, 620. Certain programs have 640s or higher. Reach out with any questions. Hope you're doing well. Thank you so much for your business and support, and I look forward to working with you.